Both the Aussie and Kiwi dollars rise as rate cut views retreat. Australian October inflation overshoots the mark, putting another RBA cut in doubt, and the AUD NZD cuts, but strongly hints the cycle is over. That's coming up in our 5 Things in 5 Minutes on Thursday, November the 27th. And then in our deep dive interview, ANZ FX analyst Kausani Basak explains why ANZ Research has downgraded its forecast for the Philippines Peso.
We think remittance flows has prevented the currency from depreciating for now. The currency will be vulnerable once the remittance flows subside.
But first in 5 and 5 with ANZ. Both the Aussie and Kiwi dollars rose yesterday as investor views on future rate cuts in both economies retreated. In Australia, the October monthly CPI overshot market expectations, coming in at 3.8% year on year, well above the Reserve Bank of Australia's 2 to 3% target band. The trimmed mean measure also rose. Here's ANZ senior economist Adelaide Timbrell.
The most important thing about the CPI print for October is that it had accelerated in recent months. So we have a trimmed mean of 3.3% year on year in October, and 6 of the last 7 months in the newly released history also had trimmed mean at 3% or higher. So we're seeing not only accelerating inflation based on this data, but also inflation that is on the edge or just outside of the Reserve Bank's target band.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.9% and the Nasdaq up 1.1% as December rate cut bets in the US solidified. The yield on the US 10-year Treasury rose just under a basis point to 4.008%. UK gilt yields fell in a sign of confidence in the government's budget overnight. West Texas oil futures fell 0.1% to $58.06 US a barrel. Gold rose 0.9% to $4,200 US an ounce. The US dollar index was down 0.2%. The Aussie dollar, again, up 0.75% to 65.14 US cents. And the Kiwi up 1.3% at 56.91 US cents. Number 2, Adelaide says the data will have seen the RBA sit up and take notice.
This is going to put the Reserve Bank likely on high alert for that re-emergence of reinflation risk, and it does raise the risk that we do not see any more interest rate cuts from here on in. Our call is still that we will see one interest rate cut from the Reserve Bank Board in February, but the data today, if sustained, does add to the risk that the Reserve Bank do not see the need or ability to cut the cash rate.
Number 3, there was a change in how the monthly CPI was reported, however. Instead of the partial monthly indicator previously published between quarterly CPIs, the Australian Bureau of Statistics, the ABS, has developed a new monthly series covering 95% of the consumer basket.
That measure only goes back to 2024, which means the seasonal adjustment of each tiny category that makes up the consumer basket is not really long enough to be as accurate as what we've seen in previous data sets. And that means that this data series is also potentially more subject to revision than the last one, which means, yes, we got a 3.3% in October, but 6 months from now, we might look back on what the ABS says the trimmed mean inflation was for October and find that that number is no longer 3.3%. That's also something the Reserve Bank Board understands and will keep in mind when they are looking at the data.
Number 4, the Reserve Bank of New Zealand cut its official cash rate 25 basis points to 2.25%, as expected yesterday. But ANZ New Zealand chief economist Sharon Zollner says it was the RBNZ's guidance that moved the market.
There was only 5 basis points more of easing in the track, which means that they think it's slightly likelier that if the official cash rate were to be moved in coming months, that it would be a cut, not a hike, but really nothing to suggest that they expect to be cutting again. The market was a little bit disappointed with that, so we saw the New Zealand dollar jump in about 0.5 cent and then carry on a little bit more even, and the 1 and 2 year swap rates were both up about 10 basis points as the market moved to basically price the same chance of further easing that the Reserve Bank had indicated, which is really only about a 20% chance, whereas previously the market had been pricing that as likelier than not.
Number 5, Sharon is projecting the OCR to stay on hold through 2026 at this stage, a long time for the market to debate when the first hike will come.
It's interesting that the Reserve Bank's forecasting only 0.4% growth for Q3 GDP, whereas we are seeing upside risk to our forecast of 0.5. So if we did see the data come out, the GDP indicators suggesting that the Reserve Bank's going to get an upward surprise on the near-term data, then not only will the very slight chance of more easing disappear, but the market's minds might turn relatively quickly to the question of when hikes will come. Now, of course, on just straight after they've just eased, it's very early to be discussing that, but the market doesn't like to stand still.
Sharon Zollner there. Now, in our deep dive interview, ANZ FX analyst Kausani Basak looks at why the Philippines Peso looks set to fall further in the near term. She was talking to my colleague Alex Tarrant.
The Philippine Peso has been an underperformer this year, declining by about 2% against the USD. And in October, it depreciated past the 59 level. This level was important because the central bank has intervened in past occasion at this level in 2022 and 24. But now the central bank is letting the currency weaken. It has also stated that it is not defending any specific level and is allowing the market forces to drive the currency. This suggests that the BSP is opting to preserve its FX reserves and is open to further weakness.
Now, we're approaching a time of year, this typical November-December remittance season in the Philippines. What usually happens during these couple of months and how does it affect the peso?
In these 2 months, Philippines receives higher remittances due to the holiday season. Overseas Filipino workers send back money to their homes in the Philippines during this period, and this tends to be positive for the PHP, and it tends to appreciate in these months. But in recent years, these positive effects has been offset by a large trade deficit, which has capped the currency's gains. And this year also, the impact of remittance inflow is likely to be limited because of domestic factors which are expected to overshadow the seasonal remittances support.
And then once that remittance season is over, what pressures are going to come on the currency and is it likely to weaken further?
The PHP has been fluctuating around like 59 level this month, and we think remittance flows has prevented the currency from depreciating for now. The currency will be vulnerable once the remittance flows subside and the fundamentals start to dominate. This is why we are downgrading our near-term forecast for the PHP and expecting it to weaken once the peak seasonal flows are over. Our new forecasts see the PHP weakening towards an all-time low of 60 by the first quarter of 2026 before it gradually recovers for the rest of the year.
Then what are you seeing more generally in terms of the Philippines economy or the fiscal stance that might be putting pressure on the currency?
There are significant downside pressure for the economy. Since the corruption scandal linked to flood control projects first emerged in July, economic activity in the Philippines has been negatively affected. The Department of Finance is estimating economic losses from ghost projects could be about 0.4% of the GDP, and the impact is also evident in the Q3 GDP numbers, which slowed to about 4% year-on-year, and it was significantly below the market expectation of 5.2% year-on-year. Now, the slowdown was primarily due to a sharp drop in fixed capital formation, which was driven by reduced public infrastructure spending amid governance issues. Government consumption has also slowed down. Weakness in government spending is expected to persist in Q4 as governance concerns remain unresolved, likely spilling over to private business and consumer confidence, which both have been subdued in the recent months. And also, there has been major cabinet reshuffle recently, and this has heightened the growth uncertainty. This follows the resignation of the president's executive secretary and the budget secretary during the ongoing investigation into the flood control scandal.
Kausani Basak there talking to Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, November the 27th. Catch you tomorrow with detail from a rate decision in Korea. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.